Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. One of the hottest topics in the investment management space over the past 3 to 4 years has been fixed income markets. Bond prices experienced a tremendous 40-year run while interest rates were on a steady decline since really the early 80s. But that all came to a crashing halt following the pandemic. I have a very special guest on, and one who is a very esteemed rate strategist to talk about the fixed income markets and what we've been experiencing recently. But first, today's episode is sponsored by the award winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So, with that, I'd like to give a warm welcome to David Ader. David is a former chief macro strategist at Informa Financial Intelligence and previously held senior roles at CRT LLC and RBS Greenwich Capital. He was the number one ranked U.S. government bond strategist by Institutional Investor magazine for 11 years and was the number one uh, in technical analysis over 5 years. David, thank you so much for coming on the show. When we were colleagues, I always thought it might be fun to create a podcast with you. And when I started Adjusted for Risk, you were one of the first people I thought about having on as a guest. So here we are. Thank you again. So what have you been up to lately?
Well, in my semi-serious retirement, the fun things include going back to school for a variety of topics, but mostly archaeology, something that's long interested me. So I've been pursuing classes in that and leading archaeology digs where I live in Fairfield, Connecticut, finding Native American spots going back 10,000 years, traveling a lot, and had been continuing to write about the markets. I wrote a bit for wealth management, but Bloomberg and Barron's were my main outlets. I was doing their economics column for a while. And I gave it all up just as the bond market was becoming extremely interesting after having not been interesting for a period of time. So here we are. Oh, I'm also on the board of a few different organizations. Some are investment related, and others are pure nonprofits in the environmental area, fishing specifically.
Okay. Well, you brought up fishing, and we talked earlier, and when we were colleagues, where I talked about being out here in Lake Tahoe, there's a lot of great fly fishing and trout fishing out here in streams and rivers. So I'm still waiting for that phone call for you to come out here and say that you're ready to do the Walker or the
There
Truckee
you go.
River. So
It'll happen.
I'm
It'll
still
happen.
waiting.
It'll happen.
Awesome. Like you said, it was said at the opening. I hate to use the word boring for bond markets, but over that 40-year time period, bond markets were a little bit boring. But that in the past 4 years, it's been anything but boring. So let's start with just a very brief post-pandemic recap. We had 10-year yields fall to 0.5% or 0.5%, followed by 1-year yields spiking to 5.5% last year. What in the world did we just experience?
So before I give you a specific answer, the post-pandemic world, since you talked about the bond market for 40 plus years, because I did start in it almost 40 odd years ago. When I was in graduate school, interest rates, I would get a weekly note from Fidelity Cash Reserves paying 20 odd percent. So I would take my student loan that I'd get in August, put into Fidelity Cash Reserves until December when I had to paid that part of my tuition. So even then, even then I was aware of interest rates. But it had gotten, of course, they had gotten rather dull before the pandemic. But to the question, what did we just experience? And I say this, and I don't mean it to be as facetious as it may come across, but reality, the reality being deficits. There's a massive amount of, we've had deficits for decades now, but it increased dramatically in the years prior to the pandemic. And then stimulus, massive amounts of stimulus. And what do the two things create? Well, they create inflation. There's a lot of liquidity in the market, and particularly around the pandemic. Not only was this taking place, but that cash, the stimulus,
Mhm.
was going into people's coffers, but they couldn't really spend it. And so as we were coming out of it, we see, and it seems inevitable in retrospect, this spike, a temporary spike in inflation, which of course got the Fed to do something, which is to hike, and got the entire structure of the market to see yields rise dramatically. We had 10-year notes, just over 5%, which looks cheap today, and historically it really isn't all that cheap. So all that's going on, and at the same time, and again, I'm going to get back to this concept of reality. At the same time, we see the Fed slow down and then stop quantitative easing, and not only the Fed, but central banks around the world. And if we go back to the great financial crisis, what was the subsequent massive shift in the structure of the fixed income marketplace, particularly in the sovereign side, was central bank purchases of bonds. At one
Mhm.
point, central banks were buying a majority of the outstanding bond market, and that stopped. And you bring this all together, and so that's what's happened.
Interesting. That's a fantastic recap. It is such a dynamic time environment, period for fixed income. And it's interesting. I hate to say that there was so much pain involved when bond prices fell, but at the end of the day, it was really needed, right? Especially for savers. Yes, it hurt when you had treasuries which were supposed to be safe falling, you know, 15-20% on the long end. And but at the end of the day, it was one of those things that we need after years of interest rates and yields at historically low levels. It was kind of like we needed a recalibration or normalization there, as painful as it was. But um, it was needed, I thought. The Fed, you mentioned the Fed, it's been under fire since the pandemic, as most believe the central bank left rates too low for too long. And it really ultimately left many to question the Fed's actions and statements. And the Fed really has a credibility problem. Do you believe it can resolve this issue and regain the confidence of investors? And what will it take?
Well, I want to go back a little bit further in time. Um, the Fed and all central banks, their role, if I can call it that, and their activity changed again going out of 2008, 2009, and then we're dealing with the peripheral crisis of Portugal, Greece, Italy, Spain, et cetera, and then of course Brexit itself. So central banks have gotten, well, let's just stick to the Fed. They've gotten much more involved in this sort of political, grand economic structure, not just about their concerns of employment and inflation, and perhaps dollar stability, but all these other influences coming in here. And I think that their credibility, in my opinion, started to deteriorate with quantitative easing. Now they are manipulating the market's perception of the long end of the curve. So you're very right to say that we are normalizing. But of course, people, particularly in the markets, tend to have relatively short memories. So with all the quantitative easing, we take that for granted, even though deficits are rising. But that's not an issue when the Fed is buying and other central banks are buying most of this sort of stuff.
Mhm.
So I would say that the Fed is probably moving to a point in time where their credibility is fine. They will indicate what they're thinking and what they're doing, and we'll see it at all the Fed meetings. But at the same time, because the financial markets, not just the bond market, the stock market and other things, have been so dependent on low interest rates to support um, buybacks, for example, and the housing market, again, at what I will refer to as artificially low rates. So now that the Fed is kind of the way it's always been, rather this boring, well, we're looking at things, we might hike, these are our targets, da 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 da. Um, People say, well, what do they mean? What are they saying? Let's look at the Fed expectations. Let's look at those silly things. Where are they going to be in 3 years? Fed doesn't know. Those are projections. They're not guidance. So I don't think the issue is Fed credibility, but I think it's the markets, you know, tendency, and we see it, we see it in the youth of America. Like, hey, look at TikTok. What is Twitter telling me? Or X, formerly Twitter. What are they saying? You're looking for little sound bites
Yeah.
as opposed to trying to take it in altogether. So I don't think the Fed has a credibility problem. I think the market needs this information immediate. They need it as accurate as possible. And when they don't get it, they complain. So that would be my comment on the Fed. I don't think it's a credibility, and I think we need to be aware the Fed, like the rest of the world, be looking at inflation. We're going to be looking at all the other influences the way we used to do it,
Mhm.
and I think that that becomes a challenge.
It's really interesting that you do very good thoughts there. And when we think, you mentioned, do we as investors maybe take what the Fed says too literal? Like you said, they don't really know. We've got the dot plot, right? Everybody reads the dot plot. And now markets, they were struggling here at the beginning of the year, and yields were falling because they thought, oh, the Fed's not going to cut in March like traders expected them to. And do we look into the Fed actions too much?
Absolutely. And the thing because I was there when the Fed started the dot plot concept, and at the beginning, oh, it's interesting. And then people hang on it, investors hang on it because they don't want to make their own long-term
You're
decisions in
right.
some regard. What is the Fed telling us? And if there's a shift, if there's a nuance, oh, the Fed is not as friendly or as we had hoped, counting the number of words in the statements and making these subtle changes. I again, this it's part of my age thing that people are just they want give me sound bites, give me sound bites about this sort of thing, and I think that um, there is such a dependence. Make it easy. What do you mean? What are you doing? And if there's a change because there's a change that in something the Fed is looking at, or if they indicate we're considering, and if that's not hardcore, then people, get very upset about that. So, to the question, to the issues, it's very much like the 24/7 news, whether it's CNN, MSNBC, whether it's Bloomberg or
Yep.
CNBC. 20, you got to fill out all this noise 24/7. There used to be before all that stuff. They didn't have. Well, the market is up today. Oh, the Fed governor slipped on a banana peel. It must mean something. You're filling in for a lot of little things just to fill out the day, and I think that people become dependent on it. And I think there are astute Fed watchers out there who will tell you that, but then you become boring and they don't listen to you. So I don't know if that really answers the question, but I think we hang on these little elements of the Fed and try to make a bet on them.
No, I think that's a fantastic answer. We talked about rates and yields earlier. Where do you see the yield curve in 2024? Do they normalize? Does the curve steepen, or does it just flatten? And what's the catalyst?
So first off, that's a great question, and I'm going to give you an awful answer. 2024 is one of those periods in time where, wow, there's more uncertainty. When we always say there's uncertainty, that's what kept us employed as economic strategists. But this year we have this unusual election, two incumbents running against one another. We have everything going on overseas with various wars and the potential for those to go. And we have a potentially softening economy. It could be a soft landing, all things being equal. I would say I would be in the soft landing camp. So I would see that inflation would be starting to come down a little bit more, not to the Fed's true targets, but a little bit more, which should give them some pause. And I would think also that the longer end of the yield curve, seeing the front end starting to stabilize and perhaps respond to maybe anticipation of an ease, but I think that hopes for an ease are far-fetched until we actually get some much softer data. I think the Fed's on hold, frankly speaking, at
Mhm.
least for the first 6 months of the year. And then I think the back end, and we see the curve, disinvert, and I think that we see the back end start rising accordingly. I think by the middle of the year, we could see a very, very flat yield curve and possibly the curve steepening out if, in fact, we do get an ease or if some event overseas causes us to have a problem. And I'm going to be saying this throughout this discussion that, you asked me earlier about what did we just experience. I said the reality of deficits in particular, lack and the end of quantitative easing. And I think that the story for the bond market in the next couple of years, of course, is going to be about the Fed at the front end.
Mhm.
But I think that dealing with the financing of U.S. debt when foreigners are less inclined to be buying U.S. debt, when the Fed is not buying U.S. debt, I think is going to be a story that'll keep the back end under some pressure. I would not, even though I believe in a soft landing, even though I believe that inflation can come down somewhat more, and even though I think the Fed, could ease perhaps in the second half of the year, I think that we could see 10-year notes once again 4.5%, 5%. So if you were to ask me for the trading range for 10-year notes over the course of 2024, I'm not sure what's going to cause it to rally, but let's just say that we had an event, something, a war, something, and maybe it hits down to 3.5, 375. That would be my very low end. I would be a big seller there, but I think that the bias would tend to be upward, and so my range trading would be 3.5 to 5%.
Interesting. Fantastic. Great information there, David. You answered a lot of my questions.
No, ask it again. I'll repeat them. I'm
There
good.
we go. Well, let's say the way rate markets have been moving in a month when you're back on, that might change, right? Um, so
Oh,
this is one of my last questions and one that I'm kind of most interested in. What would David Ader do if he was Fed chairman?
that's a good question. I've often pictured myself in there and wondered why they never tapped me on that. So I'm a gradualist. So looking at the front end, and let's make the distinction between the front end of the curve. I think that it is obviously the hikes have slowed down sharply. I don't think there's anyone really calling for further hikes.
Mm,
And so I would be in that camp, but I would be slow to ease. I would like to see, I would like to save my easings or keep the powder dry, which is an unfortunate expression in a war-like environment around the world, if we have an event. And
mm,
let's then ease and make it meaningful. But in the meantime, I want to see inflation come down a bit more. I want to see if it is in fact a soft landing. Obviously, we're coming out of last year,
mm,
this year, with the stock market very, very high. That tells me something. So I would be cautious on easing, and I'm usually bullish, by the way. So this is unusual for me. And I say, as Fed chairman, I would like to have a discussion and bring it out to the market, to be mean, and say, all right, look, we got a huge portfolio. We've stopped buying. When do we sell?
yeah.
When do we start selling? And that would tend to, of course, put some steepening pressure on the curve, which would help the banking world in terms of their lending policies. And I also think, and I think this is me, but it is important. Over these years, the Fed chairman, we can go back to Greenspan in particular, had criticized Congress for not doing their share of business when it came to our fiscal situation. And I
Mhm.
think Congress has been irresponsible. So if the Fed were to start selling some of the securities in its holdings, longer stuff, and start scaring the markets a little bit, maybe that would cause the administration or Congress
Mhm.
to wake up and say, hey, look, we got a deficit problem in here. I don't know how else the Fed would be able to influence them because no one's listened to them in that for 30 years. So certainly I would be slow to ease, and I might consider things at the longer end of the curve in terms of reducing the portfolio.
Great. David, that was such a fun conversation, some great insight. Thank you so much for coming on this show. It has been really a pleasure to have you on. And as I expected, it was truly insightful. Hopefully, we can do it again here in the near future as the Fed continues its journey to unwinding its easy monetary policy, and we can talk further. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Zephyr's Adjusted for Risk YouTube channel, as well as on iHeart and Spotify. Thank you very much, and have a great rest of your week.